Asset allocation is the process of spreading your investment capital across the various asset classes, which includes cash, bonds, and stocks, also known as equities. The starting point is defining your investment goal and calculating the required rate of return needed to reach this goal. For example, you're retiring soon, and in order to draw a growing pension for the next 20 years, your required nominal rate of return amounts to 8% per year. If we assume inflation averaging 4.5% over this period, your required real rate, in other words, the nominal rate minus the inflation rate, is 3.5%. In a South African context, it's quite obvious that investing in cash will not provide the required return. The obvious and only solution is to allocate capital to riskier assets, meaning bonds and stocks. Historically, the various asset classes delivered the following real returns: cash around 1 to 2% per annum, bonds 3 to 4%, and stocks or equities 4 to 6%. Assuming the real return is 1% on cash and 5% on stocks, an allocation of around 35% cash and 65% stocks will get us to a 3.5% real return. There are a few factors that will influence your final asset allocation, namely your risk profile and the time horizon of the investment. To appreciate the effect these factors will have on your asset allocation, we need to take note of the asset's return characteristics. Cash returns produce a smooth upward sloping curve as long as the bank does not go bust. The slope steepens when rates increase and flattens when rates drop. Bonds, on the other hand, especially longer dated bonds, will have higher returns over the long run. The value of a bond investment will, however, fluctuate as investors' bond rate or yield expectations change. For example, bond rates might increase when a downgrade of the bond issuer is expected. An increase in bond yields will lead to a capital loss and vice versa. Investing in a company's stock gives you part ownership of that company. You therefore share in the company's good and bad fortunes. Historically, owning stocks gave you the highest return, but generally speaking, as we move through the business cycle, there will be periods of negative returns. So from a time horizon perspective, the assets you include in your asset allocation should be appropriate. If you intend withdrawing in the short term, cash is your only option. Over the medium term, bonds and perhaps some high quality shares could also be included. And over the longer term, the focus should be on stocks. When all is said and done, probably the most important test your asset allocation should pass is balancing it with your risk profile. It is of no use constructing a high risk, meaning large exposure to stocks portfolio, if you are not willing to stay the course. It is prudent to give up potential higher growth in exchange for lower, more steady growth, if that's what your risk profile dictates. Modifying your portfolio over time by lowering the risky exposure will lower the portfolio's volatility as you approach the intended maturity date. Apart from constructing a portfolio with the potential of providing your required rate of return, allocation to different asset classes, locally and globally, will have a diversifying effect which will reduce overall investment risk.